Good morning and welcome to Joe Stamet Live on this beautiful, hot Monday morning, June the 22nd. Thank you for joining me today. I was thinking about what we were going to be talking about today, and it dawned on Sarah and I that since COVID started, we have been taking steps to inform everybody about CMHC. What does that mean? We've been taking steps to talk to people about the new rule changes. What does that mean? And how that impacts you. But one of the things that we haven't talked about is what does it mean to use a mortgage broker, specifically us? What does it mean to be a 5% down buyer or a high ratio buyer? And then what does it mean to be a buyer with greater than 20% down? And also, another call that we're getting quite a bit lately is what does it mean to refinance my home? I want to take equity out. So I have as a very special guest today, Sarah Crawford is on my team. Sarah's worked with me now for 5 years, and we're going to have her come in today more as a mystery shopper. She's going to speak to me as though she were a client in both scenarios or in all three scenarios, whether it be less than 20% down, more than 20% down, or she wants to refinance her house. And we're going to try to touch on some of the things that we get asked most often. What do we do? How does it look? So without further ado, I'm going to introduce you all to Sarah Crawford right now. Sarah's going to come in, with technology being what it is. With a click of a button, here she is. Hi, Sarah.
Hello.
Hi. Thanks for joining me today. And again, we're just going to do a little bit of role playing here. So Sarah is taking care of all of our marketing and advertising. She's our client liaison. She's our lender liaison. She does basically the majority, but she does a lot of things in our office. So Sarah's a great person to have on today because she's going to be able to address this from perhaps some of the questions she's heard us answering for clients. So Sarah's going to be first a high ratio buyer, somebody with less than 20% down. So Sarah, what would a high ratio buyer, high ratio client ask me? What do you think some of the questions are that you hear jumping out?
Well, I think initially it's what do you want to see from me to begin with? Like, what am I going to have to provide you
As
a client?
Yeah.
And what is it any different being a high ratio client? Like, what does that mean?
Okay, good question. So let's look at a buyer coming to us with less than 20% down. Your requirements or what the information documents that we need from you are going to be the same as pretty much any other buyer. But what it means to be a high ratio buyer is, again, with less than 20% down, your mortgage has to go through 2 stages of approval. So you have to not only meet the criteria of the lender, whether it be a bank or a monoline lender or any one of the number of lenders that we work with, you have to meet their criteria, but you also have to meet the criteria of the insurer. And what the insurer means is that by law, if a bank is lending you greater than 80% of the value of a house, your mortgage has to be insured. And the 3 insurers out there are CMHC, Genworth, and Canada Guarantee. CMHC is the name that most people are aware of, most people refer to. It's the Kleenex, let's say, of mortgage insurers, but they are not the only insurer. So one of those 3 insurers is who the bank will then choose to approve your mortgage or to insure your mortgage. So Sarah, you've come to us, you have, let's say, 10% down. We as a broker have to confirm your employment, and especially in COVID times now, everything is getting approved in real time. So I need to get up-to-date income letters, up-to-date pay stubs. We need to confirm your identity because most importantly, we need to know that we're dealing with Sarah Crawford as Sarah Crawford has presented herself to us. We need to know that you are who you say you are. We need to work with your credit and make sure that you meet minimum requirements. Some people may have heard that CMHC is changing their minimum credit score as of July the 1st to 680. The other 2 insurers are not changing their credit profile. So you just need to meet certain minimum criteria when it comes to credit. You then need to prove to us your source of down payment. We need to know where every penny of your down payment is coming from. And a lot of people suspect or think that we're being intrusive, and we're not trying to be. We just need to know every penny or the source of all of your down payment because of AML laws, anti-money laundering laws. We need to make sure that you're getting it legitimately from your own resources, not borrowed. You could get it as a gift from family, but it cannot be borrowed funds. So from that standpoint, we're going to put you through the same rigmarole, the same questions that we would put any buyer through, but it's a little more stringent when it comes to CMHC, Canada Guarantee, or Genworth. So those are the criteria you would have to satisfy in order to move forward.
And there's a premium I have to pay to be insured. Do I pay that out of my pocket, or does it get tacked onto the mortgage?
That's a great question. So bottom line is this: your mortgage insurance premium is based on 3 scales. You have 5% down, 10% down, 15% down, and then no premium. So at 5% down, you're going to pay the highest premium, and all of these premiums, regardless of the insurer, those premiums get added to your mortgage. So let's just take a quick example. If you were buying for, say, $400,000 and you had 5% down, that's $20,000. Your mortgage now would be $380,000 plus the CMHC fee, and that CMHC fee is based on a percentage of what you're borrowing, and it gets tacked onto your mortgage. The only out-of-pocket cost that you as a consumer have for the high ratio insurance premium is the tax that gets paid on that on the day of closing, and generally speaking, it's PST that gets paid.
Okay. And is the rate going to be worse because I'm insured, or does it matter?
Quite the opposite. And this doesn't sit well with some, but if you have a high ratio mortgage, so again, less than 20% down, you in fact will have a better rate than somebody that has 20% down. And the reason for that is because the banks are able to mitigate their risk because of the insurance. Therefore, they're able to pass savings on to the client by offering them a lower rate.
Okay. And then do I have to bring all my documents to you? Like, do we have to meet face to face to get all this done?
No. You've come up with some good questions there. So, no, we do everything virtually. We do everything remotely, and we have done for many, many years. It just, with COVID now, people are adopting this as being the new way of doing business, when in fact it's our old way of doing business. This is the way we've always conducted ourselves. So we can do everything remotely. We have a very secure portal that you can send documents through, and those documents then get reviewed by myself and our underwriter, Janice Tinker, who some of you have met on previous calls. We have a question. Bear with me, Sarah. With only 5% down, could that mean you have a mortgage for more than the purchase price? Please explain the amount of the insurance at 5%. Very good question. Okay. It's not at the point where the insurance premium then drives your mortgage amount higher than your purchase price. So to take that example I just gave of 400,000 with 5% down or 20,000 down, you would have a mortgage of 380. The insurance premium is 15,580, and so that gets added to your mortgage. So you now would have a $395,580 mortgage on a $400,000 purchase price. So the insurance premium, most certainly, there's a huge expense, and it's a cost associated with doing that type of business, but it is also the cost associated with helping you get into home ownership. Okay. It's giving you the ability to get into a home at the time you're ready, whether it be employment-wise or down payment-wise. It gets you into a home because you have a lifestyle that perhaps you're trying to achieve, and you want to live somewhere, and you want to own where you're living. So that is the cost of associated with putting less than 20% down.
And do I have to pay that insurance premium every time I refinance? Is my mortgage always going to be insured?
Great question. The goal is that you get into home ownership with your, let's say, 5 or 10% down, because you're breaking into the whole home buying process. In the future, when you sell, the hope or the expectation is that you built enough equity in your property and you paid your mortgage down enough that you're going to walk away to allow you to get into your next property with 20% down or more. It's not a crime if you end up buying this subsequent property or any future property with less than 20% down and have to be insured again. It's not a bad thing. That's not necessarily the goal. The goal would be to get into home ownership, realize appreciation, take that appreciation with you to the next property, and get into it with greater than 20% down.
Okay. And if I wanted to put 20% down, how would that work? What would make that any different?
Okay. So basically, what we find is that people that have, say, 15% down, they're going to do what they can to stretch it to 20% down, because to avoid having to pay that insurance premium, would be ideal for most.
Mm-hmm.
And if you're sitting with 5% down, to stretch yourself to 20% or to find the resources to get you to 20%, that's a pretty far climb. So 5%, most people would just go in with a 5% down payment.
Mm-hmm.
But if you're at 15 or 18% down, you're going to find a way somehow, some way to stretch that to 20%. At 20% down, the advantages you have are that you can amortize your mortgage over a longer period of time, therefore reducing your monthly payments. Secondly, your insurance premium that we talked about in the previous example is not realized. You don't have to pay that insurance premium with 20% down.
Okay.
Your interest rates are going to be, again, slightly higher than that of an insured mortgage, but still you're not paying that sizable premium. You're not accruing that premium over time. So even though you are paying a higher rate with 20% down, you're still in a very, very good position. You have then what's called a conventional mortgage. So the advantage to you as a consumer is a conventional mortgage allows, again, longer amortization and a little more freedom on those qualifying ratios that we talked about earlier. So we don't need to be so specific within a box, within a certain criteria. We can stretch that a little bit in the event somebody maybe has a car loan that's just bringing some of the ratios a little over the line. With 20% down, there's a little more freedom with that. So the advantages are you just have a more well-rounded free mortgage with 20% down or more. But then again, the advantages with less than 20% down, as we talked about, is it got you into home ownership. It got you into a home without having to wait until you accumulated the full 20% down. You ended up getting a better rate, but yes, you paid a premium for that rate. So there are advantages to either scenario. It depends on what your lifestyle permits.
So if I want to get to that 20%, what happens if my parents are giving me the extra money?
Well, first of all, you'd be very, very nice to your parents. And if they are gifting you that extra money, that's beautiful. So you are allowed in any scenario to get a gift from family members, and it needs to be an immediate family member. It cannot be your friend Johnny down the street that's gifting you money. It has to be mother, father, brother, sister, grandparent, somebody that has an interest in seeing you succeed. So that just legitimizes the gift. So if your parents are willing to gift you money, you're blessed and you're lucky. And from that standpoint, we can use that as your down payment.
Okay. And do you need to see anything from them?
Absolutely. We would need a signed gift letter confirming that they're gifting you the money and there's no form of repayment required. In some cases, if it's a large enough sum that they're gifting you, we need to see their source of money as well to make sure that it's coming from legitimate sources. The key thing, and I've touched on this a couple of times, is that we need to legitimize all sources of down payment, whether it be small or large. We need to make sure that we are doing our job and our due diligence on behalf of the banks and the lenders to make sure that we're vetting out where your down payment's coming from and it's legitimate legal sources. Okay. So, and what else would you want to know as a consumer? What do you need payment? What do you want to know about that?
So what are my payment options? And can I increase my payments at any time if I have extra money? Can I put extra money down on my mortgage, or do I have to always just pay that monthly payment?
Well, you have the option with most lenders to pay weekly, bi-weekly, in some cases semi-monthly or monthly. And you have the options of making what are called prepayment privileges on your payments. So in other words, you have the ability to increase your regular payments, and you also have the ability to make lump sum payments toward your principal pay down intermittently throughout the year. So let's say, for example, you borrowed let's just say a $400,000 mortgage. In some cases, you have the ability to pay anywhere between, say, $60,000 and $80,000 of extra money each year toward your mortgage payment or toward your mortgage balance. And that gets credited toward the balance right upon payment. You have the ability to increase your payments by a prescribed or prescribed amount that the lender sets out in their contract. And it could be an increase of 10%. It could be an increase as high as 20%. So if you're paying for, let's say, $1,000, you could increase your payment in some cases to as high as $1,200. And that additional portion gets credited toward your principal repayment right away. So there are provisions built into mortgages quite regularly that allow you to pay your mortgage down more rapidly. However, be very, very cautious, because a lot of the rates that you're hearing online, a lot of the low rock bottom discount mortgage rates come at a cost. And some of those costs are that they either limit those levels of prepayment, or in some cases, they strip those levels of prepayment away. So as a consumer, you need to be aware that the people you're talking to and the mortgage offerings that you're getting are full service mortgages, as we refer to them. So
Yeah.
getting the ability to port your mortgage to a new house, you're getting the ability to prepay principal as you see fit, as you're able to. You're getting the ability to adjust your mortgage and refinance your mortgage, where some of these rock bottom rates are stripping those features away. And you don't find out about them, perhaps in some cases, until you need it, which unfortunately is too late. So make sure you keep your mortgage eyes open, or you're dealing with somebody that is informative enough that's going to make sure that you are being well informed throughout the entire process and you know exactly what you're getting.
And if I'm a seasonal worker and I make it much more money in the summer than I do in the winter, is there any way that I can help with that?
Yes. So there are certain mortgages that have it's actually called a match a payment, miss a payment, or match a payment, skip a payment option. And for those seasonal workers, what we can do is we can give you the ability to double up on the payments while you're gainfully employed and your cash is king and you're making money. And then during the months of layoff, you can actually take some of those months off because you doubled up previous payments. So from that standpoint, it's a very good budgeting tool for a seasonal type employee to make sure that their mortgage payments do not get missed.
Okay. And do you choose my lawyer or do I choose my lawyer?
See, everybody, this is proving that Sarah, although she hasn't been in the office in now 7 weeks, she did listen when she was here, because these are all the questions that people ask. So this is great stuff. No, you have every right to choose your own lawyer.
Okay.
And, we can always refer a good lawyer to you, but it's your relationship with that lawyer that's going to help you close that deal. So that's your call. That's your choice. You're free to do. And you can also choose what is called internal funding, where some of the banks will go through what is called a title insurance company to close your mortgage in lieu of needing a lawyer. And you can do that through what's called internal funding process. And sometimes I'm not a fan of that. I would rather you use a lawyer, because that way everything's more in control. But in some cases, the internal funding process is most certainly viable.
So, and I know there's two different types of lenders, monolines and banks.
Yeah.
With a monoline, they don't have other products, they're just mortgages. But if I choose to go with a bank, do I have to switch all my banking over to that bank?
No. Holy smoke. Excellent. So to expand on that, I've always said that I have in excess of 30 plus lenders, and we do. And we have credit unions, we have private lenders, we have chartered banks, we have monoline lenders, as Sarah touched on. A monoline lender is exactly that. It's a monoline. It's one line. They only do mortgages. They don't have bank networks. They don't have branch networks. They don't do, for the most part, lines of credit. They don't do safety deposit boxes. They don't do daily deposits and things like that. So they are lenders that were established over the years, and their role in the marketplace is to lend big bank money. So you have the chartered banks that we deal with, and then we have our monoline lenders that we deal with, who are in fact getting mortgages directly from a big bank, and they are lending it. We call it a white label mortgage, call it whatever you want, but they're lending legitimate lending sources from chartered banks. So one thing that we always do when we're working with a client, regardless of the lender that we place them with, is that we don't ever make the mortgage contingent on a banking relationship. We want that client to bank where they're most happy. And if our lender that we did place them with does have the ability to bank, and they can convince the client that banking with them is going to change their life or make their life a lot easier, then by all means, it's up to that client to choose if they want to have that relationship with the lender. We don't ever force the client to do that, and nor do we let our lender even ask that question.
And if I choose to go with, like, say, Scotiabank right now for 5 years, when I refinance, do I have to stay with Scotiabank, or can I change if I didn't have a great time?
That's a great, well, let's hope that we place you with an institution that is going to be the right institution for you at the renewal time as well. But in the event they're not, then you're free to shop, and we're free to shop for you. So whenever we place you with somebody today, it's with the intention that they're going to be the right lender for you down the road as well. It doesn't always work that way. So we will gladly help you shop the marketplace. We will gladly help you refinance your mortgage come the time of renewal, or even in between. to perhaps take care of some unwanted debt that you want to consolidate or you want to renovate, we can get access to some money for you to renovate your property. But you're not at the time of renewal obligated at all to stay with that lender unless, again, we talked earlier about the stripped down mortgages or no frills mortgages. Some of them do not have the ability to port to another property or to change to a different lender. So again, be cautious.
And do you always recommend a 5-year term?
No, not really. We find that the 5-year mortgage is the most common mortgage that people think of. But I would say that every mortgage has a purpose, or every mortgage has its day. Right now, you would think, given that we're in 2020, a U.S. election year, there are people that follow and have followed for many years U.S. trends, and they follow U.S. elections. So a lot of people will take a 4-year term in this day and age with the expectation that 4 years from now, we're heading into another U.S. election and things might tend to stabilize. Well, this year has proven that whole theory somewhat invalid, simply because there's no stability in the world today with what's going on with COVID and with what's going on south of the border. So from that standpoint, I don't know if choosing a 4-year term is the right way to go. But if somebody is unsure of what term they want to go with or how long they want to commit themselves to a lender, going with variable is always a good choice. So we will talk about that. We'll speak to people about fixed terms as well.
Okay.
Now, you didn't ask me the most important question, Sarah.
I can't think of it.
How much do I charge?
Oh, right.
Okay.
Well, I don't ask that because I know.
Oh, there you go. So we don't charge fees. If your mortgage is a qualified, bankable or chartered lender type mortgage that we can place for you, and please understand the role that we're here to play is to source you the best mortgage that's going to help you accomplish what you're trying to. It doesn't always mean the best rate. It doesn't always mean the rock bottom rate, but we will most certainly get you the most competitive rate for all the services that you're looking for in a mortgage. In that case, there are no costs or fees for our services at all. We get paid by the bank. The only cost that you would incur would be your standard appraisal fee. And sometimes we can even get that waived, but an appraisal fee and your own lawyer's fee. So back to your question earlier about, do you get to choose your own lawyer? You choose your own lawyer based on your feeling and based on your relationship. And in some cases, you might choose your own lawyer based on cost and fees. So that's the other fee you have. If we, as a broker, cannot get you placed with a, let's say a chartered bank or a monoline lender or a lender that pays us, and we have to in turn charge a fee, which accounts to or amounts to very few deals in our roster. If we have to charge you a fee, we disclose that fee to you up front. So that way you know exactly what you're about to encounter. But generally speaking, there are no costs for our services. So thanks for asking that question.
Yes. Yeah. I can't think of any other questions that I would have.
One thing we didn't talk about was when somebody wants to refinance.
Yeah.
Okay. So we've talked about high ratio mortgages and conventional mortgages. Let's talk now about the individual or individuals that they're in their house. They have no intention on moving, but they're deciding or choosing now that they want to take some of the equity out of their property to put in a pool or to renovate to some, or they want to take equity out so they can go and buy a secondary property as an investment. So that fits into a completely different bucket than the previous two that we just talked about. The first one we talked about, again, was buying with less than 20% down. The second one was buying with 20% down or more. In this particular case, as a refinance, you don't fit, or a client does not fit into that high ratio bucket or really that conventional bucket. As a refinance bucket, you are what's called an uninsurable mortgage. So we have to source you the lender that will allow you to refinance and take equity out of your property. And not all of them do. So out of the 30 plus lenders that we might deal with, we might have 5 or 6 that will do a refinance. So your options are somewhat limited. Interest rates are still very, very competitive, but your options they're different in that scenario. And one of the things to point out is that some of those rock bottom rates that people are seeing advertised today, they don't always apply to a refinance like we're talking about now. So let's say, for example, you had a house that was worth, again, say $500,000. You're only allowed to refinance up to 80% of the value of that house. So it's worth $500,000. The highest mortgage you can take out is $400,000. If you own already a $320,000 mortgage, then that means you have access now to $80,000 of equity that you can grab onto, that you can access. The other 100,000 of equity that's remaining in the property is to remain there. It's not to be accessed because, again, the law stipulates that you cannot refinance greater than 80% of your house.
Okay.
The reason for that is to take precautions to make sure that people are not eroding all of the equity in their homes and then becoming undervalued or over leveraged. And in a lot of cases, that could have got you into trouble. So refinancing is another option people could entertain.
Okay. And do I have to get an appraisal when it comes to refinancing as well? Or how do they figure out what my house is worth?
We work off of what you believe your house to be worth. We'll do our own little market research to find out what we think the house is worth. And then we will order an appraisal to confirm what we were all suspecting. So it's the appraiser's job to go out, not necessarily the way they used to, but to at least to get a feel for what the market conditions are in your area, and then compare that to the features and options in your home to what has sold out in the marketplace in recent weeks and months. And then they can assemble a value of your property, and they will be the ones to tell us what they think it's worth and what it's legitimately worth in fair market today.
Okay.
Great job, Sarah.
So, okay. Well, I don't think I have any more questions. Do you think there's anything else that we can touch on?
No, I think we touched on everything. And just so everybody knows, I put Sarah on the spot on Friday saying that she was going to be on my Zoom call today. So great job, Sarah. I really thank you for for being a good sport. So,
it wasn't as bad as I thought.
I told you. It's fairly easy. I think if anybody has any questions or concerns, and I've said this before, please keep sharing these posts because this is information we want to get out to people to help people navigate the whole mortgage world and the whole COVID mortgage world. So if there's anything that you want to know or need to know, or friends that you have that perhaps you think could benefit by this, put them in touch with us and we'd be more than happy to assist in any way we can. The response that we've been getting to our previous Facebook Live sessions has been absolutely astronomical. We're so very, very pleased with everybody trying to share information. And I think that's what this is all about. We need to get the knowledge out there and let people know that there are people who care. So Sarah, you did a great job today. Thank you. And now I think either we can both sign off or you sign off.
Okay.
All right. Bye, everybody. Thank you.
See ya.